I don't hold gold because I want to make money, but I hold gold to preserve my purchasing power. I don't think there was a catalyst really to push the gold price higher. But as I said, money is not tight. And when Nvidia goes into the sky and cryptocurrencies go up ballistically, some money then sells these assets that go up strongly, and they look for something relatively safe. And they also gradually come to the conclusion that the governments will continue to print money.
Gold prices have displayed a modest uptrend during Tuesday's first half of the European session. However, this upward movement lacked significant momentum, leaving the precious metal hovering close to its weekly low of around $2,150, which was reached in the preceding trading session. Renowned investor Marc Faber, known for his insights in the Gloom, Boom, and Doom report, suggests that any specific catalyst doesn't drive the recent uptick in gold prices. Instead, there seems to be a prevailing sentiment among investors to seek out relatively safer assets amidst the volatility seen in other markets, particularly cryptocurrencies. Over the past year, a pivotal question among market observers has been when the Federal Reserve might decide to cut interest rates. This decision holds significant economic implications, particularly as it coincides with the upcoming U.S. presidential election. Lowering interest rates could be perceived as a political win for President Joe Biden. Faber further speculates that the Federal Reserve might maintain an accommodative monetary policy, particularly given the backdrop of an election year in the U.S. Such a stance could fuel demand for gold as a hedge against inflation. Echoing this sentiment, analysts at TD Securities foresee a positive outlook for gold, projecting a target price of $2,250 by the second quarter of 2024. However, recent warmer-than-expected U.S. consumer inflation data has fueled speculation that the Federal Reserve may soon adhere to its higher-for-longer narrative regarding interest rates. This, coupled with the prevailing bullish sentiment in global equity markets, poses a challenge to the upward trajectory of gold prices. Faber emphasizes that the primary purpose of holding physical gold isn't necessarily to generate profits, but rather to safeguard purchasing power, especially considering factors such as age and decreased life expectancy. Join us as we explore Marc Faber's insights. Stay updated by subscribing to our channel and activating notifications. Thank you.
I don't think there was a catalyst really to push the gold price higher. But as I said, money is not tight. And when Nvidia goes into the sky and cryptocurrencies go up ballistically, some money then sells these assets that go up strongly, and they look for something relatively safe. And they also gradually come to the conclusion that the governments will continue to print money. It's an election year in the US. The Fed is not a friend of Mr. Trump, that I can assure you. They will do everything to get the Democrats reelected. And so, in my view, it's likely that the Fed, whatever the conditions are, will keep money easy. Now, it could be that interest rates don't go down, but they can supply liquidity to the markets to keep the markets up, or even supply more liquidity to push markets up so people feel good and they vote for Biden. High level is difficult to tell and to determine. Now, I take an example because I grew up in the 50s, so I can say how much a croissant was in 1950 when I went to school. It was 15 cents, and now it's maybe 2.50 or 3 or whatnot. And how much a coffee was. I remember we went on Sunday nights because my mother was working, so sometimes we were alone at home. My brother and I went to a local restaurant, and for 5 francs 50, we had a full menu: starter, main dish, and dessert. And now the same meal would cost, I don't know, 50 francs. So up, say, 10 times in Switzerland. In America, it's maybe more. But the gold price was at $35 in 1970. It's now 2,000. So everybody complains that gold hasn't done well. No, it's done actually quite well. It has kept its purchasing power. And that's why I hold a large gold reserve in physical. I don't hold gold because I want to make money, but I hold gold to preserve my purchasing power. And also, I'm at an age where the life expectancy has diminished. So
So you
anyway,
don't own mining stocks, I guess.
I also now this because you said we will talk about investments. I prefer physical gold, but I can see that gold miners are not only extremely depressed against the S&P, they're also extremely depressed relative to the price of gold, silver, and platinum, to the physical price. And so for a long time now, I never increased. I always hold some gold shares because I was on the board of several mining companies until they kicked me out. But but now, for the first time, I'm buying again some because especially the South African gold mines are incredibly cheap because both South Africa is in the dumps and the mining sector is in the dumps. I mean, Nvidia, Apple, and so forth, they're worth more than the entire mining sector in the world.
A U.S. inflation report released on Tuesday sparked speculation that the Federal Reserve might postpone interest rate cuts, bolstering U.S. Treasury bond yields, supporting the U.S. dollar, and exerting downward pressure on gold prices. The headline U.S. Consumer Price Index for February showed a year-over-year increase of 3.2%, matching expectations and slightly surpassing the previous figure of 3.1%. Meanwhile, the annual core CPI, which excludes volatile food and energy prices, edged up to 3.8%, slightly above the anticipated 3.7%. Marc Faber underscores the disproportionate impact of inflation on lower and middle-income groups, highlighting how it favors affluent individuals who possess assets that typically appreciate during periods of inflation. Inflationary pressures have eased since the Fed's 2022 rate hikes. Expectations for rate cuts this year are delayed, with analysts now eyeing June or later, as recent data indicates a slowdown in progress. Faber suggests that central banks might downplay the actual inflation rate to retain control over interest rates and manipulate perceptions of economic stability. This strategy could allow them to delay policy adjustments, maintaining a semblance of stability in the financial markets. Let's get back to the interview.
How fast do the standards of living go down? You understand? When we talk about the depression of the 30s, within 2 years, there was a remarkable economic and financial slump. In other words, stocks collapsed, high yield bonds collapsed, banks collapsed, and the people lost their jobs. In other words, the unemployment rate went close to 30% in the United States. The governments have learned that if you have excessive debts, the only way to come out of this debt problem is either you increase taxation significantly, but that is difficult in the current economic environment, but it would be possible. But the problem with tax increase is usually it hits the lower classes and the middle class the most, whereas the rich people, they can avoid paying taxes to a large extent. The second way to deal with debts is to default. That is also very difficult because you have local creditors and international creditors, and it's very messy. So the third option is to inflate. And here I have to explain very distinctively, inflation is nothing else than a tax. This tax arises because the government expenditures are larger than the government revenues. And so a deficit occurs, which usually is then financed by a central bank. In the case of the US, the Fed, by printing money, and in Europe by the ECB nowadays. But it's a tax. And someone pays this tax. Unfortunately, this tax is a very unfair tax. It hits the lower classes and the middle class much more than the wealthy people. The wealthy people frequently benefit from inflation because it leads to a concentration of wealth in the hands of a few people, and so forth and so on. And people who are born and inherit assets, real estate, stocks, bonds, commodities, and collectibles, paintings, and so forth, they benefit from inflation, basically. So this is an unpleasant tax, and it lowers the standards of living of ordinary people. The debts will never be repaid, but the servicing will become a problem, and has become already a problem in the US, in the sense that the debt was growing since 2009, since 1981. But as interest rates fell, the interest payments on the debt never really went up. For the last 2 years, that interest rates have gone up, the payments of interest on the debts are becoming a problem. But now you see why the central bank has an interest to say that inflation is, say, 6% or 7%, when in fact it's maybe 8-9%. And I just like to remind your viewers to also look at long-term charts of interest rates and inflation of what happened in the 1970s. The model of the 1970s would suggest that we are now at the very beginning of an inflationary spiral that will last for maybe 20, 30, 40 years.
With inflationary pressures potentially being downplayed by central banks, how might this affect investor perceptions and strategies regarding asset allocation, particularly gold? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.